Okay, let's go ahead and deal with partially owned subsidiaries when there is a differential, and let's just do the consolidation at date of acquisition. I'll do a separate slideshow for the consolidation after acquisition. Now, again, the case of a partially owned subsidiary with a differential isn't that much more complicated than a wholly owned subsidiary with a differential. The only differences are going to be, first, we're going to have to create a non-controlling interest account in the S entry to establish the beginning of year non-controlling interest, just like we did in the no differential case. We're going to have to in the D entry, we're going to have to allocate the dividends between our investment account and the non-controlling interest, just like the no differential case. And third and finally, when we do the income to the non-controlling interest, we're going to allocate to them their share of the adjusted and realized subsidiary income. The adjusted and realized subsidiary income is their reported income plus or minus the effects of any elimination entries which affect the subsidiary's income statement. Now, since this slideshow just does the consolidation at date of acquisition, the latter two items here, items 2 and 3, aren't going to apply. Let's go ahead and start with a fresh example. Let's assume that on January 1st of 1, big company buys 60% of little company for $450,000. The fair value of the non-controlling interest on that date is $300,000. Little's book value is $500,000. And Little has inventory which is undervalued by $50,000, FIFO basis, and property, plant, and equipment with a 10-year life which is undervalued by $100,000. First, we have to do our cost versus book value analysis. And again, we're going to need columns both for our 60% as well as for the total. First, we have the cost and fair value. Again, our 60% cost $450,000, our 60% at $450,000 plus the non-controlling interest at $300,000 gives us the total of $750,000. And again, we're going to assume, almost always we're going to assume this strict proportionality, where if the whole thing is worth $750,000, our 60% costs 60% of $750,000, or $450,000. We then subtract the book value, and again, the total book value is $100,000. Our share of that is $300,000. So the total differential is $250,000. Our share, 60% of that, or $150,000. And again, what do we have? Why does this differential exist? Why do we pay more than book value? Well, part of the reason was there was undervalued inventory. Inventory is undervalued by $50,000, and again, that's the total. So our share of that undervalued inventory is $30,000. Similarly, they have some undervalued property, plant, and equipment, which is undervalued by $100,000. And again, what that means is their property, plant, and equipment is worth more than book value, therefore the company is worth more than book value. We're explaining away part of that differential, that's why we subtract it. And again, if the total property, plant, and equipment differential is $100,000, our share of that is $60,000. Whatever's left must be goodwill. So $100,000 total goodwill, $60,000 for our share. Again, we're going to need both of these columns. For the purposes of accounting for our investment under the equity method, we're going to need the information from the 60% column. That represents our investment, what we own. For the consolidation, we're going to need the totals from the items from the total 100% column. We're going to record 100% of the inventory differential, 100% of the property, plant, equipment differential, and 100% of the goodwill. Okay, let's go ahead and assume the balance sheets at the date of acquisition, January 1st, 01, appear as on the following slide. And again, I sort of just picked these numbers out at random. The only constraint was assets must equal liabilities, Little's total book value is $500,000, and the investment in Little is $450,000. Everything else, just a bunch of random numbers. And again, let's go ahead and record the elimination entry needed for the consolidation at date of acquisition. In other words, just the S entry. No income, no dividends, no amortization, no nothing like that. So what do we do in the S entry? We eliminate the subsidiaries' beginning of year equity accounts, so we debit common stock and retained earnings for their beginning of year balances. We record the various differential asset values. We're going to add $50,000 to inventory, we're going to add $100,000 to property, plant, and equipment because they're both undervalued, and we're going to go ahead and record $100,000 of goodwill. Okay, those 5 debits combined add up to $750,000. And again, who owns that $750,000? Well, we own $450,000 of that, our 60% of that $750,000 total, and that's our acquisition cost. That's our beginning of year investment. The other 40% of the $750,000 is owned by the non-controlling shareholders. So again, we're going to establish this equity-like account called non-controlling interest. So we go ahead and post that entry to the worksheet, debits to the debit column, credits to the credit column, and we add across, keeping in mind the debit and credit rules. Now remember, this is a consolidation at date of acquisition. In the subsequent year, after we do this on January 1st, at the end of the first year, we've created $50,000 of additional inventory under assuming a FIFO inventory flow. That inventory is going to be sold by the end of the year. So we're going to go ahead and establish we're going to allocate or write up Little's inventory by $50,000, and then at the end of the year we're going to say, hey, that's been sold, and we'll transfer it to cost of goods sold. Similarly, the property, plant, and equipment is going to be increased by $100,000. That has a finite life of 10 years, so it's going to be amortized or written off over 10 years by an annual adjustment to depreciation expense of $10,000.